Today, I'll share with you how to build a $1 million portfolio using the Acorns investing service. Acorns is extremely easy to use. It's a turnkey service, but you do have choice in what you're investing in, and that depends on what your risk tolerance is and other things that you do, and that will shorten or lengthen the timeline it takes you to become a millionaire. If you're new to my videos in particular, I've been reviewing Acorns for like 5 years and making general investing videos for the last 6 years, and so you're in the right place if you want to know more about Acorns. Fast forward to this point in the video if you want to skip a general overview of what Acorns is and how it works, because I understand some of you are already using Acorns, so you don't need to know how it works because you're doing it. For everyone else, for the next couple minutes, I'm going to just describe how Acorns works, how you invest in it, and how you set up your account to pick the kind of risk and things that you want. If you're not already familiar with Acorns, it is a very simplified version of what it takes to invest in the stock market. It's an investing app, essentially, and it also has a browser, but it's really meant to be used with an app. And they got famous for their roundup feature, which is where you just tie a bank account or a purchasing card of some kind, like a debit card or a credit card, to your Acorns account, and then any remaining cents over and above whatever you've spent money on, like if you spent $1.50, the next 50 cents would be taken out of your checking account and then put into your Acorns investing account. And so it's sort of this like easy way for you to trick yourself into investing more. It's not free money, but you're investing without having to make that commitment every time you invest. And it's really that and the ease of use that's like their claim to fame. It's extremely easy to use. I don't think there's an easier investing service out there. So if investing is like intimidating for you, or if you're very new to it, or you just don't want to learn a lot of investing things, which you don't have to, that's not a requirement to invest, then it's a good service. Setting up an Acorns account is as easy as setting up most bank accounts or investing accounts or whatever. You go to the Acorns app, create a login, you answer a few questions that they ask you, you link a bank account that you already have set up with like a Wells Fargo, a Chase, a local credit union, whoever you're using. You've got to link that to Acorns because that's where the money comes from. And then based on the answer to the few questions that you answer whenever you're setting up your account, Acorns is going to recommend a few things to you. It's going to recommend whether or not maybe you want to use a retirement account or just a standard brokerage account. The difference is, do you want to lock the money up for a long time to retire, or do you want to have access to it a little bit sooner than that and not have to jump through any hoops, make it really easy? You could use a normal taxable brokerage account then. And it'll also kind of assess what your risk tolerance is. I think it's a tricky subject though, because especially if you're newer to investing and you want an investing service like Acorns to take the weight of the learning curve off of your shoulders, how do you know what your risk tolerance even is? I wish there was almost like a quiz before that quiz to say, how do you know what your risk tolerance is? You've almost got to weigh how much you're willing to risk with how aggressive your goals are, because that's what really informs what your risk is in my mind. Like for me personally, of course, I don't want to lose money. Nobody wants to lose money, but at the same time, I can't sleep at night if I know that my investments are doing so little for me that it's like a waste of time. I need to ratchet up that risk enough that I feel like it's worth it, not too crazy, but enough that like my money's actually going to grow over time and it's not just going to sit there and do nothing. And I just get the feeling that some people are asked these kind of questions like,
what's your risk tolerance level? How aggressive do you want to be?
And everyone thinks, well, I don't want to lose my money. Like I don't want to be putting myself and my future at risk by doing anything so crazy. And what you don't get is the overall context of what it means to invest with a service like Acorns. Acorns is picking very safe, diversified, broad kind of index funds and ETFs and things that typically have proven to be really safe over the course of time. Is it a guarantee? No, of course not. Nothing with your money is a guarantee, especially not investing. But in the scheme of things, like if there was a scale of not risky things to extremely risky things, Acorns would be like maybe in the middle, probably like on the safer side compared to all the things that you could do. And so that's not really taken into context whenever they ask you, like, how much risk do you want to have? They're not saying over the whole gamut of all investing options, what would you want to do? They're saying like within the boundary of what we are willing to do, how risky do you want to be? And that's really at the shallow end of the pool. It's like, do you want to be 1 foot deep in the pool or 4 feet deep in the pool? Either way, you're not in the ocean. It's very, very safe. And to be clear, all of those are my opinions. That's not the way Acorns pitches all this. That's not an official message from anybody. That's just my take on the kinds of things that Acorns invest your money in. Speaking of that, what is Acorns investing our money in? Because they're essentially something like a robo-advisor. They don't really pitch themselves as that, but they are taking your money and investing it in a way that they think is going to accomplish what you say your goals are and your risk tolerance is. So they are doing that work for you to distribute that money in the stock market in various ways. On the Acorns website, you can see the specific ETFs that make up all their portfolios. It's just going to be a different mix of these depending on the risk tolerance you chose. And to really get into the weeds of what this is, you kind of have to know more about the stock market. So if you're a beginner, this still probably won't make sense. But basically, the more stocks that you own, the more risk you take and the more your return should be. So if you're investing in a lot of companies whose job it is to make money for the company, you're investing in like Toyota or whatever, they exist to make money. And so if they make money and their share price goes up, the price of their stock goes up, then you stand to benefit from that. And so they're investing in hundreds or thousands of different companies, some of them big, some of them small, some of them in America, some of them internationally, in the hopes that doing that then spreads your money out. You receive all the growth of those companies over time. And even if a few of them fail or have a really bad year, it doesn't negatively impact you that much. That's the whole point of using these funds. They're like baskets of different companies that you're investing in. Then likewise, there are things like bonds, like there's a bond ETF down here, T-bills, short income, short-term bond kind of things. These kinds of things are not investing you in a big company whose job it is to make money. These take your money and they invest it in different things like bonds or T-bills or other kind of financial products that should give you a return, but should give you way less risk than investing in companies. And so when you fill out that little form and you open an Acorns account, if you say, I want to be as aggressive as possible, I want to pursue the most growth I possibly can, then they're going to put you in a bunch of companies and not that many bonds and the other things. Like for example, my portfolio right now is the maximum aggression you can have with Acorns, and it's large company stocks, mid-sized company stocks, small company stocks, international company stocks, and emerging market stocks. All I have to say, it's all stocks. There are no bonds, there are no tips, there are no anything else in here. And there's 5 ranges of risk. And so I'm at the aggressive end. If you're at the safe end, then you're probably in very few stocks and you're in a lot of bonds and T-bills and other things like that that are essentially getting you a little bit of a return, but the level of risk is like next to nothing. It's not nothing, but it's very close to nothing. Okay, big long-winded discussion of how Acorns is set up is now over. And the reason that we went through all of that, the reason we talked about what makes up the things that you invest in and the scale of less aggressive to more aggressive is that directly impacts what your expected returns should be. Remember, the return is the money that you're going to make on your money. And if you're investing in things that have very little risk, you can only expect a very small return. What that means for us is it's going to take a very long time for that money to pile up and make money on money. That's the reason we invest. And so in choosing something with very little risk, you are choosing to make less money. Likewise, for me, I'm choosing the most aggressive thing possible because I want the chance to make the most money possible. I also have the biggest chance of losing a little money here and there because the stock market doesn't always go up. It goes down every now and then. But by and large, over the course of time, it has gone up. So I'm essentially putting my faith not in Acorns, but in the US economy, in the world economies, in world peace, to say business will persist. We will keep adding more and more value. We'll keep finding ways to increase the value of businesses and the world and economies, and the value of all the things I've invested in will continue to go up. So I, and anyone else who's investing in a more risky way, in a more aggressive way, stands to make the most money, have the highest returns, have our money replicate on itself faster than somebody who's not risk averse. And if you're like me right now, you want to know what's the difference? Like, how big of a difference is it to go from not very risky to more risky? Acorns doesn't publish what they think they're going to get you in terms of a return. They can't predict that. They'll only make you mad probably if they do that because they'll over or underestimate it. There's no real way to know. But I have guesses. If I had to just spitball out there, if you put a gun to my head and said, you have absolutely got to predict what these accounts are going to give us based on our risk tolerance levels, here's what I've come up with. I think that on the aggressive end of the spectrum, we can probably expect something like a 6 to 10% return per year. That's basically in line with the stock market average overall over the course of the last, 20, 30, 40 years. And so I'm putting it in that range. If you had to pick a single number between 6 and 10%, let's pick 8%. In the middle risk areas, I would guess it's something like 4 to 8%. 4% on a normal year, 8% on a really good year. Again, I could be way off. It could be way more or less than this. But if I had to guess, I think it's going to be in that range. So between 4 and 8 is 6%. Likewise, at the low end of the spectrum, very low risk, I'd be shocked if you made more than 2 to 4%. Could be wrong there, but generally bonds and these other kind of vehicles don't earn a huge return. And so between 2 and 4% is 3%. These are the numbers that we're going to use to kind of forecast out how long it'll take you to become a millionaire using Acorns. Let's start on the aggressive end. Let's say you want to start from zero today, become a millionaire in 20 years, investing aggressively. How much money do you have to invest every single month? Thankfully, Acorns puts a little calculator on their website for us, so we don't have to guess. We can just put the numbers in right here. I'll do a screen recording for you so you can see this. If our initial deposit is $1, our average annual return is 8%, which is right there in my guesstimate range. Who knows if I'm right or wrong, but we're picking a number. That means you'll have to contribute almost $1,700 a month to become a millionaire in 20 years. I feel like you can look at that two ways. I'm kind of nervous to break that down and give you that number because some people are going to look at that and go, that's a ton of money. That's a mortgage that I have to invest just to become a millionaire in 20 years, 2 decades. That takes forever. Other people might look at that and go, that's pretty amazing. to go from zero to literally having $1 million in an account in 20 years. The average American net worth is never even close to $1 million. So you're going from like low middle class to way above middle class in the span of 20 years. That's amazing. If that's a little too aggressive for you and you don't have $1,700 a month sitting around that you can invest, I know some people do, but a lot of us don't, then maybe you're okay to take 30 years. If you're 30 years old, you invest $671 a month every month for 30 years, boom, $1 million with just an 8% return. The average American, as far as a retirement balance that they have, like if they have an account of money set aside right now to retire on, it's around $200,000. So this is 5 times more than that. I know inflation is going to eat away at the cost of this a little bit, or eat away at the value of this sum, but still, this is going to put you way above the average American. And if you're on the younger side, or you're optimistic about living forever, maybe you're a Brian Johnson fanatic and you're going to get 10 hours of sleep every night and live to be 150, and you have 40 years to invest, then you only have to invest $287 a month to make this happen. $1 million, $287 a month. It's not even a car payment. Easy peasy. Now remember, these figures were for the most aggressive Acorns portfolio, and my guesstimate as to the average annual return you can expect could be more, could be less, but now it's going to be for sure less, because anybody who's investing with a moderate risk level or a low risk level is going to have a much, much lower return than this. So let's do that same math now, but with only 6% as our expected return. Oh my gosh, you're gonna have to invest so much money to become a millionaire in 20 years. It's like not even a thing. I mean, I don't want to say that. It's not that it's not a thing. It's just a very difficult thing. If you're not getting a good return, you've got to invest a lot of money or invest for a long time. That amount, $2,165. Yikes. So you see the price that you pay for your conservative approach there. The fact is you're gonna have to invest a significant amount more money. What is it, like $500 a month more, just because you have a little bit less risk tolerance. Unless something crazy happens in the stock market for like the next 10 years, and maybe you'll be laughing all the way to the bank because you're not going to lose as much as that aggressive person. We just don't know. It's up to you and what makes you sleep well at night and what makes you feel like you're doing the right thing for your life. If you're in that middle range of moderate risk with Acorns and you want to invest for 30 years, then you better be investing $1,000 a month, basically. That's going to get you there. And if you've got 40 years to invest and you don't want to have a lot of risk, you want to be in that middle range, then you've got to be investing about $500 a month to get there. But now it's time for the most daunting numbers, because anybody who's in that lower range of risk, you're in the really conservative, I don't want to have any risk kind of mode, and you're probably only earning something like 3% per year with Acorns, you've got to be investing a ton of money to become a millionaire. Which, if you've got this much money to invest every month, maybe you can afford to be really conservative, because if you're only earning 3% per year and you want to become a millionaire in 20 years, you've got to be investing over $3,000 per month. Yeesh. I guess I don't need to say yeesh. Just for me, that feels like kind of a waste of time. Like right now, you can get a high yield savings account that's 4% kind of all over the place. You can get a CD, you can get other kind of investment products that give you at least that much return, if not more, and are literally guaranteed by the government. They're insured. So to do this kind of thing and have it be so conservative, it's just not in line with my life goals and my perspective on things. But if it's right for you, no problem. Just want to show you what kind of timeline and what kind of contributions it'll take for you to get there to that $1 million mark. If you're hyper conservative and you want to invest for 30 years and finally make it to that $1 million mark, you've got to be investing about $1,700 a month. If I remember correctly, that was about the amount of money that it took to invest on the aggressive side and become a millionaire in 20 years. So that's kind of a good comparison, if you will, between the aggressive and the conservative side. It's going to take an extra 10 years, even if you're investing this aggressively, $1,700 a month. You've got to wait 50% longer to get to that same result. And then if you're super conservative and you have a really long time to wait for that investment to finally accrue over time, you can invest for 40 years at a 3% annual return. That means you're going to be investing over $1,000 a month, almost $1,100. By their calculator, $1,080 per month to make it to that millionaire mark. If you're asking my opinion, I think that the most important takeaway that we get from this little example is invest as early as you can and as much as you can. Is Acorns some kind of magic bullet that's going to make everybody millionaires? Not necessarily. But I don't think anything else is either. Yeah, they charge a little monthly fee of whatever, $5 to $12 a month. In the scheme of things, that's not going to make or break you. What will make or break you is if you wait to start investing. If you wait to get serious about investing and you're saving all this cash for who knows what, instead of investing it and letting it start to accrue on itself. I think it's easy to get caught up in what's the right investing app, what's the right mix of stocks and bonds, and which index fund is going to perform the best, and what's the next hot company, and it's like all this minutia that's outside of the realm of what's most important, which is we have got to invest as early as possible. And if Acorns helps you to break down that barrier of learning how to invest and helps open the door so you can start investing earlier, then it's worth every penny. There's no question in my mind about that. That's really where the value lies with this service, I think, is you don't have to learn a whole bunch of new stuff to get investing. If you use a service that's a little bit less friendly, like a WeBull or a Vanguard or something really less friendly like an Interactive Brokers or something that's just made for somebody who's really advanced, and you're waiting until you're at that level to start investing, then it's a waste of time. Downshift, slow down, get some money going somewhere in the stock market so that it has time to start accruing. That's the way that we build wealth. We don't build wealth by paying off our mortgage and having a bunch of home equity. You can't do anything with the equity. It's locked in the house. Like right now where we are in our home, we've got a bunch of equity, but it's not helping me pay any bills. It's not helping me buy any burritos and race cars. It's just sort of here. And maybe someday we'll tap into it if we sell the house. Maybe someday if you're old and you really want to go crazy, you can do like a reverse mortgage, something like that. But by and large, for the majority of our lifetime that we're here, we've got this equity that is stagnant. And unfortunately, that's where most Americans have the majority of their wealth, is in their primary home. Maybe I'm selfish, but I don't want my kids to just get a lump of wealth whenever I die. And in the meantime, I just have lived in this house and have sat on this equity for no good reason. I would rather have money that's set aside in investing accounts that I can actually tap into over time, buy burritos and race cars, go on vacations, do cool stuff. And no, it doesn't mean you like default on your mortgage, but I think you get what I'm saying here. We've got to do something that's different than the average American to get better than average results. The only other tip I can leave you with is to set up recurring investments to automatically happen if you are going to get investing, because for me, that has made the discipline of investing effortless. Like, in some ways, I'm a very disciplined person, but in other ways, I'm not. I'm disciplined enough to like run every week, but I'm not disciplined enough to refrain from eating all the chocolate chip cookie dough in the house. So for me to have to choose to invest every single time I do it, that's a lot harder for me than just setting it up to happen automatically. Like my wife gets 401k money pulled out of her check every month. It's put in the account. We're not constantly deciding if we can do that or not. It's just sort of happening. We're making everything else happen outside of that, like bills and stuff. I'm going, oh boy, can we pay all the bills well this month or not? We have to take some money out of savings. But in the meantime, that 401k money is just there and being invested. So I don't even have like a chance to touch it, which I think is the best thing overall. I want that to continue to happen and have me just kind of figure everything out on my own on the side over here. I feel like I covered everything that I wanted to cover with Acorns there as far as like how we get from zero to millionaire. But if I have overlooked anything gross and negligent, then please let me know in a comment. And that can also be the secret comment word for today: gross. Thanks for being here, and I'll see you guys later. Bye.